Hey everyone, welcome back to another episode in DIY Investing Education. And today's topic, one of my personal favorites, we're going to talk about covered call ETFs, or what really is a covered call strategy. Covered call ETFs, what do these terms mean in layman's terms? I'm going to try to be really not technical at all and give you or explain to you what a covered call ETF or a covered call strategy does in layman's terms. So the first very, very important thing to remember is that whether it's covered call strategy or not, you're still investing in an asset, in an underlying asset. Okay, it's very, very important to remember that. So for example, you have USCC, the Global X S&P 500 covered call ETF. Take a guess. This ETF still invests in or still going to hold the S&P 500, right? So if you go to holdings, you look, what does it have as its holdings? The Global X S&P 500 Index ETF, right? QQCC, the NASDAQ 100 covered call ETF. Guess what it's going to hold? NASDAQ 100 ETF. And you could do covered calls on many, many, many assets. These two are indexes. You could do it on a group of stocks. For example, Canadian banks. Here's the Global X equal weight Canadian bank covered call ETF, which means it's going to hold, you guessed it, the 6 Canadian banks equal weight. There's even one on Bitcoin, Global X Bitcoin covered call ETF. What does it hold? The IBIT ETF from BlackRock. So very important thing to remember, when you're investing or thinking of investing in a covered call ETF, that covered call ETF still has to hold underlying assets, right? And the underlying asset is still going to be the main force behind what kind of returns and volatility you're going to get. So super important concept to understand. Now, what does a covered call strategy or a covered call ETF do? Well, you know how there's stock market with shares are being traded, every day on the stock market, well, not on weekends. Well, there's also an options market where options on those stocks or on those indices also, like the S&P 500, are also traded. And in the options world, you have two types of options. You have a call option, which is a buy option. You have a put option, which is a sell option. So I'm not going to get super technical, but obviously covered call ETF uses call options. They actually sell, or the ETF in question is selling call options to other investors, other buyers. Now, when you're selling call options on whatever asset it is, you're taking in premiums. That is where the income comes in. That is how a covered call strategy or covered call ETFs generate their income. These are not dividends. They're call option premiums that the ETF manager is basically selling on those assets, on the underlying asset, whether it's bank stocks or NASDAQ 100, right? So that's where the income comes in. So in layman's terms, what does this mean? It means that this is the important part, everyone. Remember this. You are giving up a portion of the underlying asset, whatever that may be, S&P, bank stocks, one stock, Bitcoin. You're giving up a portion of its growth, of its upside, for those premiums, for that income. That is the key to remember. It's a trade-off. You're giving up potential growth for that income. That is essentially what a covered call strategy means. They're selling call options, hence the call part. Why is it called covered? Well, because it's pretty funny, but it's really because you're still owning those underlying assets. So in case you have to sell a portion of it to another buyer because you sold call options, you are covered. You're covered because you already own those assets in question. That's why it's called covered call ETF or a covered call strategy. So essentially, the most important part to remember, everyone, you're still investing in an asset, whether it's an index, a single stock, a group of stocks. And if the ETF manager is running a covered call strategy, it means they're giving up, or you are giving up by investing in them, that is, a portion of the underlying assets growth for that income in the form of those call option premiums, right? So that's what it is in layman's terms, everyone. That's basically it. Now, In the next episode, we're going to get a little bit more technical, and we're going to look at two very important factors to analyze a covered call strategy. There's really two factors, because now the $1 million question really becomes, well, how much upside am I giving up? Right? That is the $1 million question now. And that's where every fund manager or every covered call strategy is different. It's really, some of them are giving up more upside, some of them are giving up less upside. But the general rule of thumb is, by the way, the more upside you're giving up, the more premiums you could take in, but you're giving up more upside. So it's important to understand these two factors, and that's what's really going to determine, okay, well, I understand covered call ETFs or covered call strategy means I'm giving up upside, but how much I'm giving up. So we'll take a look at that in the next episode. Take care, everyone. Make sure to send this to friends or family that are trying to understand what this is, or maybe you are invested already in covered call ETFs. You're trying to explain it to them. You could send this video and this series as well in a specific playlist, of course, is going to cover many, many DIY investing topics. So see you next time.